$12 trillion vanished, evaporated, gone from the global financial system in less than 90 days. The mainstream financial media has reported on the losses. They have shown you the charts with the red arrows pointing down. They have interviewed the analysts who shake their heads and use words like correction and volatility and market dynamics. They have told you that the money was destroyed, that it ceased to exist, that it simply disappeared into the digital void like it was never there to begin with. They are lying to you. Every single one of them is either lying or so profoundly ignorant that they should not be allowed near a microphone. The $12 trillion did not disappear. Money does not disappear. Energy cannot be created or destroyed, only transformed. The same is true of wealth. The $12 trillion did not evaporate. It was transferred. It moved from one set of hands to another set of hands, from your hands to their hands, from the pockets of ordinary investors to the vaults of the financial elite, from the retirement accounts of the middle class to the balance sheets of the too-big-to-fail banks. What you witnessed over the past 90 days was not a market correction. It was the largest wealth transfer in human history, executed in broad daylight, with the full cooperation of the regulators, the media, and the political establishment. Ladies and gentlemen, this is Silverstorm Daily, and tonight I am going to show you exactly where the $12 trillion went. I am going to name the recipients, I am going to explain the mechanism, and I am going to prove to you that this theft was not an accident, but a deliberate strategy that has been repeated throughout history every time the financial elites need to consolidate their power at the expense of everyone else. Let me start with the numbers because the numbers tell the story that the media refuses to tell. At the beginning of the quarter, the combined market capitalization of global equities was approximately $109 trillion. The bond market added another $130 trillion. Real estate, derivatives, commodities, and other assets pushed the total to over $500 trillion in notional value. By the end of the quarter, approximately $12 trillion had been wiped from equities alone. Bonds lost another $3 trillion. Real estate values declined by trillions more in markets from China to Canada. The headline number that everyone focuses on is the $12 trillion in equity losses. But the total wealth destruction, if you believe the mainstream narrative, exceeded $20 trillion. $20 trillion. That is more than the annual GDP of the United States. That is more than the total wealth of the bottom 50% of the global population combined. That is enough to end world hunger for the next century. And according to the experts, it just vanished. Poof. Gone. Reduced to nothing. Do you believe that? Do you really believe that $20 trillion of wealth simply ceased to exist? I do not believe it. And by the time I finish this video, you will not believe it either. Let me explain how wealth works, because the lie that money disappeared depends on you not understanding the fundamentals. When you buy a stock at $100 and it falls to $80, you have lost $20. But that $20 did not disappear. It was transferred to whoever sold you the stock at $100. They received your $100. The stock is now worth $80. The $20 difference is in their pocket, not yours. The transaction moved wealth from you to them. Nothing was destroyed, nothing vanished. The wealth changed hands. Now scale this up to the entire market. When the market falls, the people who sold near the top have the money. The people who bought near the top and held through the decline have the losses. The money moved from the buyers to the sellers, from the late to the early, from the uninformed to the informed, from the retail investors who trusted their financial advisors to the institutional traders who saw the crash coming and positioned accordingly. The $12 trillion went somewhere. It went into the bank accounts of the institutions that sold before the crash. It went into the profit columns of the hedge funds that shorted the market. It went into the vaults of the entities that converted their paper assets to cash or hard assets before the decline began. It went into the reserves of the insiders who knew what was coming and got out in time. The money is not gone. It has merely changed location. Now let me show you specifically who received this wealth transfer because the beneficiaries are not random. They are the same entities that always benefit from financial crises. They are the banks. They are the central banks. They are the ultra-wealthy families who own the banks. They are the political insiders who receive advance information about policy changes. They are the corporate executives who sold their shares before announcing bad news. They are the market makers who profit from volatility regardless of direction. They are the precious metals holders who converted paper to metal before the crash began. Yes, you heard that correctly. The holders of physical gold and silver are among the beneficiaries of the $12 trillion wealth transfer. Not because they caused the crisis, but because they positioned for it. They converted their paper wealth to physical wealth before the paper became worthless. They held assets that the central banks cannot print. They owned the monetary metals that have preserved purchasing power through every financial crisis in human history. While everyone else was losing 12 trillion, they were gaining. Let me walk you through the specific mechanics of how this wealth transfer occurred, because understanding the mechanism protects you from being victimized again. The transfer happened in 3 phases. Phase 1 was the setup. Phase 2 was the execution. Phase 3 is the consolidation, which is still ongoing. Phase 1 began approximately 18 months ago. The Federal Reserve and other central banks signaled that they would begin tightening monetary policy. They announced rate hikes and balance sheet reduction. The mainstream media amplified this message, warning of coming difficulty for asset prices. But the warnings were not meant to help you. They were meant to provide cover for what came next. During the setup phase, the smart money was selling. The institutional investors who have access to information that retail investors do not have were reducing their exposure to equities and increasing their holdings of cash and hard assets. The corporate insiders were exercising their stock options and selling shares. The hedge funds were building short positions. The family offices of the ultra-wealthy were moving into defensive allocations. All of this selling was absorbed by retail investors who were told by their financial advisors to stay the course, to keep buying, to trust the process. The retail investors became the bag holders, purchasing shares at elevated prices from insiders who knew those prices were about to collapse. The data confirms this. SEC filings show that insider selling reached record levels in the 12 months before the crash. The ratio of insider sells to insider buys exceeded 20-1 at some points. The executives of major corporations were dumping their shares as fast as the disclosure rules allowed. They were not selling because they needed the money. They were selling because they knew what was coming. Phase 2 was the execution. Once the smart money was positioned, the crash was triggered. The mechanisms varied by market. In some cases, it was a policy announcement. In others, it was a geopolitical event. In still others, it was simply the withdrawal of buying support that had been propping up prices. The specifics do not matter as much as the pattern. The pattern is that crashes are not random. They are triggered at moments that benefit the insiders who are positioned for them. During the execution phase, the retail investors who had been accumulating throughout the setup phase watched their portfolios collapse. The financial advisors told them to hold on. The media told them that selling would lock in losses. The conventional wisdom told them that the market always recovers. And so they held. They watched the $12 trillion drain from their accounts. They experienced the fear and the doubt and the regret. But they did not sell because they had been conditioned to believe that selling during a crash is wrong. Meanwhile, the insiders who had sold during the setup phase were sitting on cash. They were watching the crash from the sidelines. They were waiting for the moment when prices fell low enough to represent value. They were preparing to buy back the shares they had sold at much higher prices. The crash was not a loss for them. It was an opportunity. Phase 3 is the consolidation, which is happening right now. The insiders are beginning to buy. They are acquiring the shares that retail investors held through the crash at prices that are 30, 40, 50% below where they sold. They are rebuilding their positions at a discount. The $12 trillion that was transferred from retail to institutions during the crash is now being converted into ownership stakes in the same companies at much lower prices. When the market eventually recovers, as it always does, the insiders will own more shares than before. They will have used the crash to increase their ownership of the productive economy. The retail investors who held through the crash will see their portfolios recover, but they will not have gained anything. They will merely return to where they started. The insiders, by contrast, will have used the round trip to accumulate more wealth. The recovery will make them richer, while the retail investors just break even. This is the mechanism of the wealth transfer. It is not an accident. It is not a market failure. It is the system working exactly as designed. The system is designed to transfer wealth from those who do not understand it to those who control it. The $12 trillion went exactly where it was always intended to go. Now let me explain how the precious metals fit into this picture, because silver and gold are the assets that break the wealth transfer cycle. When you hold physical precious metals, you are holding wealth outside the system. Your silver cannot be diluted by money printing. Your gold cannot be devalued by central bank policy. Your metals cannot be transferred to the insiders through market manipulation because they are not traded on their rigged exchanges. They sit in your safe, beyond their reach. The $12 trillion wealth transfer could not touch the precious metals holders. Their wealth was preserved. In fact, their wealth increased in relative terms. When equities lost 30% of their value, the purchasing power of gold and silver increased by 30% relative to equities. A holder of gold could now buy 30% more shares with the same ounces than they could before the crash. The crash made precious metals holders wealthier in real terms, even if the nominal price of metals did not change. But the nominal price did change. Gold rose during the equity crash. Silver rose during the equity crash. The flight to safety that always occurs during financial crises drove capital into the monetary metals. The same insiders who sold their equities during the setup phase bought precious metals. They understood that hard assets would preserve purchasing power while paper assets were being destroyed. They positioned alongside the stackers who have been accumulating for years. This is the profound irony of the $12 trillion wealth transfer. The victims could have protected themselves. The mechanism for protection has been known for 5,000 years. Gold and silver have preserved wealth through every financial crisis in recorded history. Every fiat currency has eventually failed. Every paper asset has eventually gone to zero. Only the metals have endured. The victims of the wealth transfer chose to hold paper instead of metal. They chose to trust the system instead of opting out of it. They made a choice, and that choice cost them. I am not saying this to blame the victims. They were misled by experts who should have known better. They were propagandized by a media that serves the financial elite. They were educated in schools that never taught them monetary history. The system is designed to keep people ignorant so that they can be exploited. The victims were exploited because they did not know how to protect themselves. But you are watching this channel. You understand what gold and silver represent. You understand that physical metals are the antidote to the wealth transfer system. You have the information that the victims did not have. The question is what you will do with it. Let me now explain where the $12 trillion specifically went because I promised to name the recipients. The first recipient was the banking sector. The major banks made record trading profits during the quarter of the crash. Goldman Sachs reported trading revenue that exceeded analyst expectations by 40%. JP Morgan's trading desk generated billions in profits. Morgan Stanley, Bank of America, Citigroup all reported trading results that far exceeded their performance during stable markets. How did they make so much money during a crash? They made money because they were on the right side of the trades. They were selling when retail was buying. They were shorting when retail was holding. They were positioned for the decline because they knew the decline was coming. The second recipient was the hedge fund industry. The funds that specialize in macro trading and crisis alpha generated returns that compensated for years of underperformance. The short sellers who had been mocked during the bull market were vindicated. Some funds reported gains of 30, 50, even 100% during the quarter when the broader market was losing $12 trillion. These gains did not come from nowhere. They came from the losses of other investors. They came from the $12 trillion. The third recipient was the corporate insider class. The executives who sold during the setup phase converted their paper stock options into real cash. That cash is now sitting in their personal accounts, in their family trusts, in their offshore structures. They will use that cash to buy back shares at lower prices, to acquire distressed companies, to purchase real assets while prices are depressed. The crash made them richer in both absolute and relative terms. The fourth recipient was the ultra-wealthy family offices. These are the multi-generational wealth pools that manage money for the billionaire class. They have access to information and strategies that are not available to ordinary investors. They positioned for the crash months in advance. They sold public equities and bought private assets, hard assets, and hedging instruments. When the crash hit, their wealth was protected. Many of them actually gained during the quarter when everyone else was losing. The fifth recipient was the central banks themselves. This may seem counterintuitive. How do central banks benefit from a crash that they ostensibly caused? They benefit because the crash creates demand for their intervention. The crash allows them to print more money, to expand their balance sheets, to increase their control over the financial system. Each crisis is an opportunity for the central banks to consolidate power. After this crash, the Federal Reserve has more influence over markets than ever before. The European Central Bank has more authority. The Bank of Japan has more control. The crash was a power grab disguised as a market event.